Greetings everyone, this is Paul of OptionForecast.com, and today we're doing an educational video on the basics of option trading. Okay, so we're just going to jump right into it. Pretty much every investor is familiar with the saying buy low and sell high. The problem is that strategy only works in bull markets. If you'd like to expand your repertoire of trading strategies and potentially profit from other market trends, options can come in handy. With options, it's possible to profit whether stocks are going up, down, or even sideways. You can use options to cut your losses, protect your gains, and control large chunks of stocks with relatively small cash outlay. Options can be complicated and risky, so it's important that you understand some options basics and strategies. Covering the basics now will make everything a lot easier to understand as you delve deeper into the fascinating world of options. Now the question is, what is an option? Okay, so options are contracts giving the owner the right to buy or sell an asset at a fixed price called the strike price for a specific period of time. So that period of time could be as short as a day or as long as a couple of years, depending on the option. The seller of the option contract is obligated to take the opposite side of the trade if and when the owner exercises the right to buy or sell the underlying asset. Now we're taking a look at an example of an option order. As you can see, XYZ is the stock the option is based on. Also, December 19, 2014 would be the date the option expires. The strike price is the 60. The option type is a call, and the per share cost of the option is $125, and we always multiply that by 100, which would be $125. Now that strike price that we're taking a look at, that's the pre-agreed price per share at which the stock may be bought or sold under the terms of an option contract. Some traders call this the exercise price. So now we're going to talk about call options versus put options. There are only two different varieties of standard options, call options and put options. Understanding the difference between the two is absolutely crucial to getting started. For each call contract you buy, you have the right, but not the obligation, to purchase 100 shares of a specific security at a specific price within a specific time frame. A good way to remember this is you have the right to call stock away from someone. For each put contract you buy, you have the right but not the obligation to sell 100 shares of a specific security at a specific price within a specific time frame. A good way to remember this is you have the right to put stock to somebody. As with stock trades, when buying or selling options, commissions also apply. Their costs should also be factored into your decision process. Now, in-the-money trades. The definition of in-the-money refers to the relationship between the strike price and the current stock price. Its meaning is different for calls and puts. A call option is in the money if it's cheaper to buy the stock for the strike price than it is to buy the stock in the open market. In other words, the stock price is above the strike price. For example, if a call has a strike price of $50 and the stock is trading at $55, that option is in the money because the contract owner has the right to obtain the stock for less than its current market value. Put options are in the money if it is more lucrative to sell the stock at the strike price than it is to sell the stock in the open market. For puts, the stock price must be below the strike price to be in the money. For instance, if a put has a strike price of $50 and the stock is trading at $45, the put option is in the money because the contract owner has the right to sell the stock for more than its current market value. At the money. An option is at the money when the stock price is equal to the strike price. Since the two values are rarely exactly equal, the strike price closest to the stock price is typically called the ATM strike. Look at that guy. Out of the money. The term also refers to the relationship between the strike price and the current stock price. As you might have guessed, it varies for calls and puts. An option is considered to be out of the money if exercising the rights associated with the option contract has no obvious benefit for the contract owner. For a call option, it means the stock's market price is below the strike price. For example, if a call has a strike price of $50 and the stock price is $45, the option is out of the money. Think of it this way. It would be more expensive for the contract owner to buy the stock for the strike price instead of purchasing the shares in the open market. So there's no benefit to exercising for the call option owner. For put option, it means the stock's market price is above the strike price. If a put has a strike price of $50 and the stock is trading at $55, the put option is out of the money. Remember, a put represents the right to sell stock. So if selling the stock at the strike price generates less money than selling the shares in the open market, the option is OTM. Alright guys, so that's the basics. Remember to check back with optionsforecast.com for more educational videos such as this one. And have a great day and happy trading, everyone.